Hi, everyone. Well, the holiday season is upon us again. I can't believe it. Michael Eastham here with a warm holiday welcome to all of our Fellowship Financial Group friends and family, ready for another market update. Thanks so much for checking us out. Let's jump right in because I got a lot of information to try to cover. Well, it happened again on November the 2nd. The Federal Reserve met and raised short-term interest rates by another 0.75% for the fourth time this year. And although the latest big increase was expected, after a short bump, the stock market still experienced a sell-off following the meeting in reaction to one of Chairman Jerome Powell's yammering, jawboning comments. You see, overall, the Fed's latest meeting was a mix of good news and bad news, but for the most part, the good outweighed the bad. One good outcome of the meeting is that the Fed said that they plan to slow the pace of rate increases moving forward, possibly starting at their next meeting in December. Well, that came as welcome news to the financial markets, which have been volatile ever since the Fed began rapidly raising short-term rates earlier this year in an effort to fight inflation. The hikes have brought the Fed's benchmark short-term rate up from near zero, that was near the beginning of the year, to a range of 3.75 and 4% currently. And this rapid pace has kept the stock market down from its early year highs by as much as 25% in September. It pushed long-term interest rates up to their highest level since 2007 and sent mortgage rates up from around 3% at the start of the year to just over 7% today. Investors and many economists feel that the Fed has been moving way too quickly to try and make up for lost time after ignoring rising inflation completely in 2021, much of that due to COVID. But the problem with rising rates so fast is that the Fed isn't giving one rate hike enough time to take effect in the economy before it implements another one. And as a result, it's possible that they've increased rates by too much already, and the effect could be a recessionary spiral that kicks in sometime next year. That's why Chairman Powell's vow to start slowing the pace was good news to investors, but it was followed by some bad news. And the bad news is that the Fed also said their target number for short-term rates is now higher than originally planned. At an earlier policy meeting, the Fed said they plan to bump up rates by only an additional 0.75%. Now they're saying they may increase them by as much as another 1.25%, which could take short-term rates over 5%. That's the news that triggered another sell-off on Wall Street because, as I've discussed before, higher or rising interest rates decreases the value of all assets and puts downward pressure on the markets in a variety of ways. But there is more good news if you do some simple math. That's because even if the Fed does keep raising rates by another 1.25% or so, at least the worst is over in terms of what they've already done. And the end of their rate hiking program is now in sight. With a slower schedule, it's hard to say how many more meetings it's going to take for them to reach that goal, but it is safe to say that it'll likely happen sometime in 2023. Of course, a lot of it is going to also depend on what happens with the economic effects of the current rate hikes and the ones that they're planning on doing. As I've noted earlier, there's a good chance the Fed has already overshot this and really set the stage for an inevitable recessionary spiral, and that is a bit of a concern. Many economists are still forecasting a recession for next year, although there's a lot of debate over when it's really going to kick in and how bad it'll be. The Fed's commitment to slowing its pace could help to soften the severity of any recession, and of course, they also have the potential power to limit its duration by progressively lowering short-term rates again, just like they did in 2019. Although the Fed insists that they aren't trying to create a recession, they are trying to slow economic growth by decreasing demand. You've probably heard the term soft landing, but decreasing the demand just enough to bring inflation down from its current 40-year high of over 8% to its normal level, or the Fed's target, which is about 2%. So even if a full-fledged recession does kick in, it's important to remember that the Fed is the driving force behind it. And as such, they're going to maintain a level of control over it. As I noted last month in our update, the situation is a bit like the fire department conducting a controlled burn. The fire will still look a little scary, but not nearly as scary as one that was started by accident and with the fire department nowhere in sight. Here's some more good news. As for now, the economy remains fairly stable by a lot of different measures, despite the high inflation and the increasing signs of slowing growth. And after a very volatile September, the markets rebounded in October, and you should see that rebound reflected in your last portfolio statements. Additionally, with the October CPI numbers dropping to 7.7%, we witnessed the stock market elation with a single-day jump of over 1,200, 200, and 750 points for the Dow, S&P, and NASDAQ, respectively. It was amazing. Now, our income accounts ended up in October an average of 2 to 3% for the month, depending on your holdings, of course, and our stock portfolios finished the month up an average of 6% over the portfolios. But of course, just as I always remind you, when your holdings drop in value, it really doesn't matter much because your interest in dividend income hasn't changed, or it has the potential to increase if you're reinvesting those dividends. Now, there's no doubt that these are crazy times, with the market seeming at times to celebrate bad news and panic over good news, just like as investors are really trying to figure things out. But let me assure you, none of it's unprecedented. This same kind of craziness always occurs when the Fed is fiddling with interest rates, and we've lived through it many times before, as recently as 2018 and 2019. As the craziness continues, the value of your investments is probably going to continue to fluctuate from month to month on paper. But again, that really doesn't matter with your overall strategy, because remember, it's all about the income. All right, well, that's all for this update. Just a quick reminder, it really is a privilege to serve each and every one of you. We are grateful for the confidence and the trust that you've instilled in us for being a part of the Fellowship Financial Group family. And as always, call our office anytime if you have any questions or concerns. I hope you have a wonderful Thanksgiving, and we'll be back soon with another update. Thank you.